Beijing is gearing up for a midterm reset. In October, the Chinese Communist Party's Fourth Plenum will meet. This gathering will steer policy, credit, and regulation through 2026. It matters for China's economy and for the world. Let's break it down. This is China Briefed. Subscribe for clear, concise, bias-free signals on China's economy, policy, and global trends. Today, we unpack what the upcoming Fourth Plenum tells us about China's next move. China's Communist Party holds a plenum about once a year. It's a full meeting of the party's Central Committee, 205 elite members. These meetings are numbered across each 5-year cycle. The Fourth Plenum lands in year 3. It's a classic midterm reset, a chance to recalibrate policy, to send new signals, to prepare for what comes next. Usually, Fourth Plenums focus on politics, but this time the shift is economic. The October session will focus on long-term economic planning. The official agenda includes 2 things: a work report from the Politburo and the first draft of the 15th 5-year plan. That's important. Beijing is starting early. They want to shape the next plan well before 2026. President Xi Jinping will use this plenum to define the next phase. The party is taking stock, what's working, what's not, and getting ready to set priorities for the rest of the decade. This meeting won't just review progress, it will send a message about where China's economy is going and what role the state will play. By mid-2025, China's post-COVID rebound was fading. Growth was soft. The property sector remained a drag. Exports slowed. Confidence dipped. Midterm slowdowns demand action. The plenum is Beijing's pivot point. In July, the Politburo met to prepare. The resulting communiqué was long, 20 times longer than the 2019 version. That's not just filler. For the first time ever, it mentioned drafting the next 5-year plan this early. A new slogan stood out: New Quality Productive Forces. That's code for tech-led, innovation-driven growth. Not just GDP, but better GDP. The language was revealing. The word stabilize came up again and again. The fiscal stance, more proactive, monetary policy, looser. The message, support growth but stay disciplined. On bonds, Beijing called for faster local issuance in the second half. That's fiscal firepower pulled forward. On liquidity, the central bank stepped in. In June alone, it injected 318 billion yuan into the system. July continued that pace. Benchmark rates were trimmed. Further cuts are likely. The goal is clear: avoid a credit crunch, keep cash flowing. Beyond that, targeted tools are back. Policymakers are directing credit into strategic areas like tech, small firms, advanced manufacturing and exports. Not blanket stimulus, but precise injections. There's a shift in sequencing too. Boost consumption now comes before expand investment. That's new. Services are being pushed forward. Tourism, culture, health, dining. These are the new engines. Policy wants people to spend and service sectors to lead. The tone toward the private sector has changed. Entrepreneurs are now praised. The message: create high-quality goods, take risks, grow with confidence. There's even a CapEx action plan in the works. Private firms are being nudged to invest again. The party is saying, we need you back on offense. On regulation, rule-based oversight is the new promise. Officials will still tackle unfair competition. But crackdowns, surprise fines, that phase is over. The platform economy gets a second chance. Fairer, more predictable enforcement is the goal. Another theme: national market integration. The unified national market remains a priority. Break down provincial barriers, standardize rules, make domestic commerce more efficient. Debt discipline remains a red line. The hidden debt ban stays in force. Beijing won't tolerate new off-book borrowing by local governments. At the same time, debt swaps and restructuring will continue. The message: support growth, but no 2009-style binge. Finally, capital markets are on the table. The Politburo wants China's stock markets to be more attractive. Expect moves to boost sentiment, cut fees, and increase dividends. Also, more support for IPOs and foreign access. The party is also promoting financial inclusiveness. That means channeling capital into real sectors, not just speculation. And then there's resilience. Food, energy, and disaster preparedness are non-negotiables. Beijing is investing in security, from grain reserves to power grids, because development only works if it's stable. In short, the tone is supportive, but guarded. Stimulus will be real, but not reckless. What should we expect in the second half of 2025? Let's start with the stimulus. It will be modest. The forecast: 5 to 800 billion yuan in additional special bonds, a 10 to 15 basis point rate cut by year end, a possible RRR cut if credit stalls. This isn't a flood, it's a steady drip, enough to prevent slowdown, but not enough to stoke inflation or debt bubbles. Now, the likely winners: AI, hardware, advanced chips, computing infrastructure. These are all aligned with new productive forces. Next, EVs and batteries. The entire supply chain, mining, refining, assembly, remains a strategic priority. But Beijing is watching for overcapacity. Expect targeted support with checks in place. Grid upgrades are also getting a push. State Grid is planning a record 650 billion yuan in investment this year. That supports clean energy and modern transmission. Green steel is another focus. Only new capacity that replaces old capacity is allowed. This keeps emissions down and quality up. Tourism and high-end services are next. Golden Week saw 826 million domestic trips. Spending surged past 2019 levels. Policy will try to keep that momentum going. Look for incentives, vouchers, events, trade-ins to spur consumption, and watch for private investment in sectors like education, healthcare, and finance. On regulation, the tone is calibrated. The crackdown era is over, but oversight isn't. The government wants healthy growth in platforms, without monopolies or labour abuse. Also, expect limits on excessive EV and battery investment. Too much too fast has led to supply gluts before. Data rules remain strict. Cross-border transfers still require government approval. Foreign firms won't get a free pass. So what are the key risks? First, tariffs. If Washington changes course, new US tariffs could land hard. Trump floated a 60% blanket tariff earlier this year. That would sting. Second, property. The sector remains fragile. Sales are soft. Developers are stressed. If confidence drops again, Beijing may have to step in. That means more rate cuts, more direct support, and possibly broader bailouts. Third, weather and shocks. Floods, droughts, or geopolitical flare-ups could derail plans. The government is hoping for stability, but preparing for the worst. So, what should we watch next? 1. Credit data. If TSF picks up, the stimulus is landing. If not, more easing may be needed. 2. The September central bank meeting. Wording and actions will matter, especially any RRR cut. 3. The plenum communiqué. When it's released, read the fine print. It will reveal long-term goals, targets, and maybe even personnel shifts. Now let's wrap with a few key takeaways. First, expect modest, meaningful stimulus. Not a boom, not a bust, just enough to keep things moving. Second, watch the favoured sectors: AI, EVs, green tech, high-end services. These are Beijing's bets. Third, don't ignore the guardrails. Debt, data, and discipline still shape policy. There's support, but also limits. The Fourth Plenum is Beijing's chance to reset, to stabilise now, and to reform for later. For investors and analysts, the October meeting is a must-watch. It will shape how China enters 2026 and how the world responds. That's today's China Briefed. If this helped you make sense of China's direction, like, share, and subscribe. Got a question or topic you want us to decode? Drop it in the comments. Stay briefed, stay ahead.